Welcome to the Deep Dive.
Great to be here.
We are jumping straight into the Q3 2025 earnings for Interactive Brokers Group, ticker IBKR.
Yep, announced October 16th.
Numbers are huge, and our mission today is really to unpack not just this record performance, but maybe more critically, understand their forward guidance.
And the global strategy they're executing, right, to keep this momentum going.
Exactly.
Yeah, this quarter was kind of a perfect storm. You had operational excellence meeting really high market activity.
Resulting in those record revenues we saw.
That's right. But I think the real story is how IBKR is leveraging that strength, how they're positioning themselves globally and, trying to mitigate the risk from potential rate changes down the line.
Okay, let's hit those core results first because they are staggering. Reported diluted EPS was 59 cents.
Or 77% adjusted.
And compared to the year-ago quarter's $1.42 reported, that's a 40% surge year over year. Huge.
And it wasn't just a surge, it was a surprise, right? That saw $1.57 adjusted. It sailed past the street's forecast of 53 cents.
Which you saw reflected in the aftermarket trading.
Yeah, stock ticked up about 1.62%, so definitely strong investor reaction. And net revenues mirrored that strength, hitting $1.655 billion reported.
Okay, but here's the number, I think, that tells the real story about their business model. That pre-tax profit margin.
Oh, yeah.
It clocked in at, well, a highly notable 79% this quarter.
79%, both reported and adjusted.
Which is significantly up from, what was it, 66% adjusted just a year ago?
That margin is the key insight, I think. You look at most traditional financial firms, they've got much heavier overhead.
Right. Branches, lots of personnel.
Exactly. But IBKR's model, it's fundamentally tech-first, heavily automated. It lets them scale revenue dramatically without costs ballooning in the same way.
So that 79% really speaks to that inherent scalability.
And the efficiency compared to competitors, yeah.
Okay, so that level of financial performance, it has to be fueled by something massive. Where did all this immense new business actually come from?
It seems like it's coming from everywhere, and fast. Customer accounts were up 32% year over year.
Hitting 4.13 million. They just crossed that 4 million mark recently.
It did. That's a big psychological and operational threshold.
And the money following those customers, that's even more astonishing. Customer equity, up 40% year over year.
Now standing at $757.5 billion.
Wow.
And here's the really incredible nugget from the management commentary.
Yeah.
They noted it took them 4 years, 2020 to 2024, to go from $250 billion to $500 billion in client equity.
Right. I remember that milestone.
But it only took them 1 year to add the next $250 billion.
1 year.
Pushing them past $750 billion. That speed, that acceleration, it suggests massive institutional and high net worth client adoption alongside the retail growth we know about.
That momentum clearly shows up in how active clients are. They're total darts.
Daily average revenue trades.
Yeah, basically how busy their clients are trading. That was up 34% to 3.62 million.
And you can see exactly where that conviction is landing when you break down the trades. Commission revenue was up 23% to $537 million.
Driven by higher volumes, obviously.
But the mix is fascinating. Stock trading volumes, up 67%.
67? That's enormous.
Yeah, huge conviction there. Options volumes also jumped, up 27%.
So people are playing direction and volatility.
Seems like it. The only segment showing a decline was futures, down about 7%. That kind of tracks with broader industry softness in, those complex derivatives.
Okay, so that high conviction, it translates into risk appetite, right?
Sure.
Which leads us straight into the massive engine for IBKR, net interest income, NII.
Always the big one.
How did they keep that pillar so strong, especially with maybe some hints of rates softening in places?
Well, NII, which, is income from lending cash and client credit balances, it increased 21% to $967 million.
Still very strong growth.
And that's impressive because, as you said, it happened even though benchmark rates did soften slightly in some major international currencies they operate in. So the driver wasn't just higher rates overall, it was higher volume of activity.
And that volume came from customer behavior, specifically those record margin loans and credit balances.
Correct. Average customer margin loans, that's money clients borrowed to trade, they were up 39% to $77.3 billion, an all-time high.
All-time high.
And customer credit balances were also really robust, up 33% to $154.8 billion. So yeah, they're earning income on both sides of the client ledger, the borrowing and the cash sitting there.
That record margin loan balance, though, it suggests clients have immense market confidence, right? Yeah. But doesn't that record leverage significantly increase IBKR's own risk profile? I mean, what if we hit a sudden, severe market downturn?
That's the critical question, isn't it? How are they managing that
Are
exposure?
they just relying on the collateral?
Well, management actually addressed this. They explicitly said they favor that margin activity trading stock on leverage over clients making what they called cheap option bets.
Interesting distinction.
Yeah, they seem to view margin clients as maybe more responsible or at least better collateralized. And they also pointed out that their exposure risk fees actually decreased by $12 million this quarter.
Decreased,
Oh.
even with record margin.
Right, which suggests the underlying risk profile from derivatives wasn't increasing even as general leverage was going up. They seem to believe the leverage they hold is, let's say, healthy and well-diversified across that growing global base.
Okay, interesting take from them. Now let's talk about the absolute star performer within NII, securities lending.
Oh, yeah. Big numbers there.
The estimated total net revenue from that activity was $314 million for the quarter.
Which is double the $156 million they earned in the prior year quarter.
Double. How does that work exactly? Just briefly for the listener.
Sure. Securities lending is, well, it can be complex, but the essence is, as IBKR's client assets grow, they have this ever-increasing pool of stocks, right?
From their own clients' accounts.
Exactly. And they can lend those stocks out to other traders, primarily hedge funds, who want to short those specific stocks. They earn fees for lending them out, especially on stocks that are hard to borrow.
So bigger client base, more assets.
Means a larger inventory for this incredibly lucrative business. It's a huge benefit of their scale.
That perfectly explains the NII strength then.
Okay, let's zoom out to expenses for a second, because there's a nuance there that makes their commission revenue growth at 23% look slightly understated.
Yeah, that's a key detail. The SEC Section 31 transaction fee rate.
The fee brokers pay on trades.
Right. It was reduced to 0 back in May 2025. Now, this fee is usually baked into the commission revenue figure, and then it's paid out as an expense later.
So since that fee disappeared, it makes the remaining $537 million in commission revenue look technically a bit less impactful, even though the underlying client trading activity was phenomenal.
Okay. So the key takeaway for you listening is that their actual commission growth from just pure client activity was probably even better than 23%.
Precisely. They had this sort of artificial headwind from the fee change impacting the top line number.
Got it.
And because of that same fee reduction, their execution, clearing, and distribution fees also dropped 21%.
And that savings.
That saving is largely passed directly back to clients, either through rebates or just lower trading costs overall, which, reinforces their low-cost competitive advantage.
Makes sense. Okay, finally on costs, before we pivot to strategy, we have to note the dramatic decrease in general and administrative expenses, down 59%.
Huge drop. But that was largely because they didn't have to repeat those major one-off charges from the year-ago quarter.
Right, the legal and regulatory stuff.
Yeah, they avoided repeating $88 million in legal regulatory matters and another $12 million from European consolidation charges. So it was just a much cleaner expense sheet this time around.
Which absolutely magnified the strong operating revenues.
And contributed heavily to that spectacular 79% pre-tax margin we talked about earlier.
Okay, so IBKR is clearly benefiting immensely right now from high interest rates, high client activity, high risk appetite. But they know, and we know, that high interest income can be fragile.
Very rate dependent.
So how are they building resilience for what seems like an inevitable rate cut environment eventually? This brings us to their forward guidance. What metrics did they give us on interest rate sensitivity?
They gave us exactly the metrics you need to quantify that future risk. The company estimates that a 25 basis point decrease, just 0.25% in the benchmark Fed funds rate, would reduce their annual NII by about $77 million.
Okay, $77 million annually. For a firm doing $1.6 billion quarterly revenue, that seems manageable.
Manageable for a small cut, yes. But what if the cuts are more aggressive?
Right, what's the bigger picture?
Then the impact becomes pretty substantial. They quantified that a full 1% decrease, 100 basis points in all relevant benchmark rates, that would decrease their annual NII by $417 million.
$417 million. Okay, that's a clear measure for investors. Future performance is highly contingent on Fed decisions.
Absolutely, and it shows why IBKR is so focused on building platform strength, adding features, growing globally to try and offset this potential revenue bleed when rates do eventually fall.
That focus on platform resilience, it's clearly seen in their new innovations. I want to spend a minute on this proprietary connections feature. It sounds like a real push towards client sophistication.
It really is. Connections is fundamentally about moving beyond just looking at a simple stock ticker. It's a tool they built in-house that lets clients discover multiple investment relationships.
Like what kind of relationship?
Things like related stocks, maybe key suppliers or customers, competitor companies, relevant ETFs, even forecast contracts that might be related to a single company you're looking at.
Huh. So if I look up, say, Tesla, it instantly shows me battery suppliers, maybe forecast contracts on EV growth, and its closest competitor stock in China.
Exactly that kind of thing. It just raises the level of investment insight instantly, right there on the platform. And apparently, it's seeing strong traction already, averaging 20,000 unique daily users.
20,000 a day. That shows clients want these tools that synthesize complex market data.
They absolutely do.
That platform strength is also showing up in their global expansion efforts, specifically things like overnight trading, which is up 90% from 2024.
90%. And this is a direct competitive advantage for them. Think about their massive international client base.
Right, for them, U.S. overnight hours are their daytime trading hours.
Exactly. So by facilitating this 24-hour access, essentially they ensure global clients don't have to wait for the New York morning bell. It makes them the go-to platform for serious global investors.
Speaking of global growth, let's talk digital assets. Their crypto strategy seems really aggressive. Trade volume's up 87% quarter over quarter.
And over 5 times year over year, the growth is explosive there.
So what's the immediate roadmap for crypto?
It's very phased. First, they're launching a European offering, partnering with Zero Hash. They expect the necessary Dutch license for that by end of October or November this year, 2025.
Okay, Europe coming online soon.
Then they plan to roll out stablecoin deposits by the end of October as well.
But the potentially biggest driver for new account inflows, I think, might be the crypto asset transfers, planned by the end of 2025. Why is that feature so critical?
It's all about the tax advantage, really. It allows clients to transfer crypto assets they already own, maybe sitting in other wallets or on other exchanges, into their IBKR account without triggering a taxable event.
Avoiding realizing capital gains.
Exactly. By removing that friction of realizing embedded tax gains, they anticipate encouraging significant asset inflows. From clients who might be sitting on appreciated crypto holdings elsewhere but didn't want to sell to move.
Makes perfect sense. And they plan staking too.
Yep. Staking planned for early 2026. So further ways to monetize those digital assets once they're on the platform.
That's a pretty comprehensive crypto strategy. Now, moving just past crypto, they also confirmed, interestingly, they're not currently contemplating sports betting.
Right, despite some speculation maybe.
Instead, they're focusing on their forecast contracts offering, which has grown 27% quarter over quarter.
Yeah, the focus there remains on macro themes, election outcomes, economic indicators, climate indicators, things like that.
And they have over 8,200 open contracts available now.
Right, up 27% QOQ. They're aggressively pushing this product, both by adding more broker partners to distribute it and increasing direct customer participation.
Okay, let's tie this all together with a strategic posture. CEO Milan Galik noted that IBKR is set apart by the, quote, trend towards more global investing across multiple client types and across jurisdictions.
And that global push isn't just about the retail investor either. Founder Thomas Peterfy highlighted the strategic importance of, quote, adding broker partners. That's a nod to the institutional side.
And it seems to be paying off. What's fascinating here is that IBKR rose to rank number 4 in the Preqin hedge fund rankings.
Number 4 for the number of hedge funds serviced.
That move into the serious institutional space climbing to number 4 behind giants like Goldman Sachs, Morgan Stanley, JP Morgan, that suggests a significant pivot or at least successful expansion.
It really does.
What specifically do you think IBKR is offering to poach those kinds of clients from the really established players?
Well, I think it comes back to that core model. Low cost, highly automated, and global reach. They offer a really sophisticated platform that can handle complex global trading needs, but at a fraction of the cost of the traditional wirehouses.
They're the lean, tech-savvy alternative.
Exactly. For hedge funds, maybe smaller asset managers who are tired of legacy systems and, frankly, the high fees those bulge bracket firms charge.
And that global diversification seems to be their shield, even that recent regulatory update in China.
Yeah, requiring mainland applicants to prove residency outside the mainland now.
Even that isn't materially impacting their overall growth figures, they said.
That checks out. The growth seems broadly represented across all geographies. It proves that, regulatory headwinds in one specific region don't necessarily stop the overall momentum when you're as diversified as they are.
So while the firm acknowledges the generic risks, market saturation, regulatory hurdles, especially with crypto, macro uncertainties like rates, competitive pressure,
Sure, the standard list.
the overall narrative is really one of a uniquely positioned global platform firing on all cylinders.
I think that's fair.
Okay, so wrapping up this deep dive then, this massive quarter was clearly driven by twin engines. That explosion in client activity, especially on high conviction stocks and options.
And the superb optimization of net interest income.
Yeah.
Largely through that doubling of securities lending revenue, even as rate environments started shifting a bit.
Right.
So if we connect this to the bigger picture, you have clients showing record high margin balances.
Right.
That indicates really strong market confidence, maybe even bordering on euphoria. Now, at the same time, IBKR is giving these confident clients increasingly sophisticated tools, like that connections feature we talked about, to help them uncover these interconnected investment risks and opportunities.
Right, making them potentially smarter investors.
Potentially. Which raises, I think, an important question for you to consider going forward. Will the combination of this high market confidence, fueled by leverage, and this high technological sophistication lead to a fundamentally different, maybe even more volatile level of capital markets participation in 2026?
Are clients simply smarter about their leverage now, or are the tools just enabling bigger, faster, more complex bets?
Exactly. Is this sophistication a stabilizer or potentially an accelerant if things turn? Something to think about.
A very potent thought to mull over. Thank you for walking us through those sources and giving us the real insights behind these really impressive numbers.
My pleasure.
And thank you for bringing this material to the deep dive. We'll catch you next time.